Okay. Hello, everybody. Welcome. I just want to understand the audience first of all. How many students are in the room? Okay. And how many professors or faculty from the Homewood campus? Okay. And then what about the medical school? And a few. And then Bloomberg, is that considered the medical school? Okay. And then how many people in the audience love finance? 1, 2, 3. Good. All right. So this is going to be a kind of a difficult audience, but that's okay.
What about the people who didn't put their hands up?
How many people from out of town? Okay. So we're just going to have fun here because I know this is more of a healthcare big data thing, but I want to show you guys a little bit of the research that we're doing in the business school. And actually, a lot of this research, actually most of this research, the real breakthroughs, especially in this paper with my co-author, Tomas, we did it on SciServer. So we actually are using the infrastructure that you guys are laying down, and thank you very much. Really appreciate it. All right? So we'll motivate this discussion. I'll tell you about the research question we're trying to answer. I'll talk to you a little bit about some of the investigations that we had, and then conclusions and extensions. And so that's what we'll do all within about 15 minutes. So the motivation, social media platforms like Facebook, Twitter, LinkedIn, YouTube, they generate a tremendous amount of data. So this is just an amazing time period we're in because basically you have all this data available to you. Anecdotally, there's some evidence that shows that this alternative data, which is social media data, has influence on the market. Okay, so there was a tweet that was done by AP. It says, breaking 2 explosions in the White House and Barack Obama is injured. It was fictitious, right? But what happened to the market? If you see that bottom panel, that spike downwards, that was exactly the price behavior when that tweet went out. Very quickly, people figured out that there was no explosion from the White House and President Obama was fine, and the market quickly recovered. But this gives you sort of a sense how integrated some of this social media data is and the financial markets. So, just to give you an anecdotal piece of evidence. So the research question that I'm pretty much interested in, and I've been interested in it for quite some time, is basically trying to understand if there's a link between social media information and security markets, right? The first investigation was a total failure. And this happened about 2010. So about, 5 or 6 years ago, I was teaching some courses at NYU Stern in the business school. I asked a bunch of business school students to manually label tweets, okay, tweets about stocks. So there was 50 students in the class. I asked them all to manually label 100 tweets each. And they put a positive if they thought the tweet was positive, and negative if they thought it was negative. So I was getting labeled data at the time. I took all this data, about 5,000 labeled tweets, and I shipped it off to the West Coast startup that was going to populate the rest of the database, learning from that labeled data. So they came back. We got all this tweet data back. This is 2010. Then I took all this labeled data that was just tweets, and I gave it to my Baruch. At the time, I was teaching statistical arbitrage at Baruch. And I said, okay, I need you guys to join intraday prices to all this tweet sentiment. And so the students who could code in C++ and so forth, they linked all the data, and we analyzed it. And we found almost nothing. We found a very sort of weak contrarian indicator. That means that people were tweeting, they were very happy, and the market would go down just a little bit. But it wasn't statistically significant. So we're like, okay, back to the drawing board. I guess, it doesn't work. I thought at that particular time it should definitely work, right? But as most researchers, we're a little bit ahead of the curve, and it happened to be at this time a couple of years ahead. And only after a couple of years did I figure out why this study didn't really work. And it was because there was not enough people using Twitter and tweets and so forth in terms of sort of giving out information about the markets, right? So in 2015. I obtained a database, tweet sentiments, from a fintech company in New York. And we actually asked one very simple question with the data. And this work was done with a graduate student from Johns Hopkins in the MSF program. We wanted to look at tweet sentiments' relationship to IPOs. And for non-finance people, IPOs are the initial public offerings where a private company comes out onto the market and first starts trading publicly. And we actually just looked at a massive amount of data, 300 observations. And we found that, in fact, that there was a relationship between tweet sentiments and IPOs. And the idea is that if there's a lot of positive sentiments about tweets, then the returns from the offer price to the first open were positively correlated. Okay? And here we're at 300 observations, and people are like, okay, fine, that's not a lot of observations. So I started to think, well, how can we get more observations? So we shifted into an event that happens 4 times a year, which is the quarterly earnings announcements of companies. So every 4 times a year, publicly traded companies must release their earnings announcements. So we actually looked around earnings announcements tweets with respect to earnings announcements. And this time, the data set grew to 8,000. Pretty impressive, right? Still, it's not really big data yet. But we found that there was this phenomenon that tweet sentiments had an influence on post-earnings announcements drift. And what that means is that when a company announces its earnings, it's either a positive surprise, meaning that the market didn't expect the company to beat the earnings, or it's a negative surprise where the company says, oh, we missed earnings, right? So that if we were talking about Apple, I'm just going to make this up, maybe has $1 per share of earnings in terms of estimates, and they come out and they say, oh, we actually have $2 of earnings, and that's a positive surprise. So what we found that was pretty interesting here is if the tweet sentiment is very negative prior to the announcement date, so people are very bearish on the stock, but a company comes out and beats earnings, then that will generate a positive return. Is that clear? So, that was something that we did. Now we had 8,000 data points, and so we're pretty happy. But it's still not big data. And so this is where the third breakthrough actually happened. And this was a collaboration between the business school and NathStat and working with Tomas. We had these 2 papers. The first one we're going to present, but I'll also show you a little bit about the second one because they're kind of combined. And the IPO paper was published. That was nice. The earnings paper was published. And now we have this 6th factor. And this is about social media derived directly from tweet sentiments. And this is what we're going to talk about. But also I want you guys to I want to show you another one that is also in line with sort of what we're doing here. And this is where the tweet sentiments, quote, we're asking the question, do they still predict the stock markets, right? So the 6th factor, this was a paper that we put together. Here is a graph. The black line is Apple's price. So over time, from 2012 to 2015, you can see this nice run-up in Apple's price and then sort of this pullback. The green line is positive bullish sentiment, and the red line is negative bullish sentiment. So if you add the green and the red, that should equal to 1. Okay, so it's the percentage of positive.
Sentiment about Apple or in general?
About Apple, about that particular company, yes. So this is a sentiment. So someone has to tweet, and I'll show you exactly how this works. Here I am in Exhibit 1, and I'm going to put $AAPL. That's a hashtag Apple. So I'm talking about Apple. It says, Apple is going to kill it today. Right? So that's my tweet. Now, I get to decide whether I want to, in that slide, move it to the right, and that will be a bullish tweet, or move it to the left, which will be a bearish tweet, or do nothing. Okay? So Apple is going to kill it today. I move it to the right. That's a bullish tweet. And now I have another tweet about Apple. $AAPL is killing me, right? And so then I move that to the left because that's a bearish tweet, and I send it off. And so that's the data that we're processing. So we get all those tweets with a $AAPL that have been classified by the user, and we plot it out here. And so visually you can see over the time that Apple from 2013 through 14 up to 15 had a nice run, there was more bullish tweets than bearish tweets, right? Now, the causality hasn't been established, right? But basically, visually, you have some evidence that when the Apple price started to come down, the number of bearish tweets, the percentage of bearish tweets and bullish tweets started to converge, right? Okay, so now here is the time series regression. And remember, this is the sixth factor, the new sixth factor. So I don't know if you guys can see it at the very bottom. In finance, we're always worried about t-statistics. We put in a factor, we want to see if the coefficient in front of that factor is statistically significant, right? So we put the social media factor for Apple. We run a time series regression, and we're looking at that coefficient. We want to see if it's greater than 2, right? So this is, sort of how we do things in finance. Here are a bunch of tickers that we looked at, and we looked at the tickers that had a lot of volume when it came to tweets. So Apple, Facebook, Netflix, not surprisingly. This is the stocks that people are tweeting about. And the final column that I'm covering is the t-stat on this coefficient in front of the social media factor per Apple. And it's like, 9, 7, 10. Yay! It's going to be published, right? So when you see that, you get really excited as a researcher because basically you're introducing a new factor. It's coming highly statistically significant on, across multiple stocks, right? So that was that, and that was the paper. The next follow-up paper that we did was we were asking the questions, do tweet sentiments still predict the stock market? Because there's been some papers that came out that says tweet sentiments predict the stock market. Here we take the number of tweets in our data set is 36 million tweets. So now we have a substantial number, not in the billions. We're still in the millions, but this is our data set over the years from 2011 to 2015. Here's some example tweets, but I'll show you. We took each of the tweets and we had their labels, and we trained some sentiment engines. We used a naive Bayes model, single layer perceptron, support vector machine, and